Finding gaps is something that we strive to do, that we encourage people to seek out. Most of the time, people that find a gap end up finding a next day up or an uptrend, because it's critical that we always look at all of the technical analysis. Excuse me. So what seems like a gap up is a case where the individual doesn't see all of the information that is displayed, and the movement will be a next day up, which would be a green candle, or it is a uptrend or the start of an uptrend. The formula for finding a gap is the three patterns: the identical patterns, or we refer to that as the one pattern or the two pattern group; the down touch, these are lines, the trend red, green, or gray that down touch one of the three, the trio lines, the yellow, pink, blue, or zero, or it spikes down under zero. So there's actually 5 different down touches that can occur, primarily with the red and green, but oftentimes when you have all 3, the trend red, green, and gray that have spiked down underneath the trio line, the yellow, pink, blue, and the trio line is under zero, you get a nice next day up movement. Sometimes 2. You just got to watch it and verify it. Now, the third group is the proximity group, and this is the power 4, the pink, blue, white, and yellow lines that are in a pattern configuration like a BOC or a TOC or a 2-day BOC. Those patterns are all listed in the documents files, and you can read those various descriptions. I would encourage you to print off that information so that you can have it handy when you're verifying things, as well as other things like the abbreviations document, in case you run into, because I have a tendency to abbreviate quite a bit. So it's an easy lookup document. Now, these 3 patterns, the identical pattern, the down touch pattern, and the proximity group pattern, are 3 groups that need to appear at the same time on the particular stock that you are looking at, because it's the combination of the forces with these conditions that give us the results that we're looking for. For example, the basic definition of a 1 pattern is 12 out of the 22 market force indicators in an identical pattern. You can see all of these identical patterns in what we refer to on the radar screen as the box color alerts. In other words, we've set up a number of box color alerts, and those color codes again are available in the documents file. It's basically just color codes, and there are a variety of them. They're in the radar screen indicator for the 22 market force recognition indicators. There's for the indicator that makes up the proximity group, or the power 4 lines, that's along with the Zion line. When you have a gap up, the power 4 is let me rephrase this. There is a very good method to identify a gap up with the Power 4, and it's in one of those, what I refer to as those 7 patterns, although there's a combination of them, so you can, some people would say 8, but anyway, 7 or 8 patterns in the 4 Power 4 lines. When they're identical, it's great. You can still get significant gaps up when the patterns are different, like 2 in one pattern and 2 in another pattern. And those are all above the Power green and orange line, and typically the Power Zion line is under the Power orange line. All the other key factor inside of the proximity group is that Power green and orange are very close to 0. Typically, the green and orange are both above 0, and they're close to the 0. But the key factor inside of this is that the Power green and the Power orange are very close together. The diff, the DIFF, the difference between the two is very close. I mean 0.03 we see hundreds and hundreds of times. 0, 4, 5, 6, 7, 8. The basic standard that we, the cutoff point that we like to use with this particular method, and it's one of the best, it's the one I have outlined in the documents the most, and that I comment on the most, and that is with, like I say, with those conditions, the Power 4 are above the Power green and are above the Power orange. Sometimes they'll come down, with the exception, excuse me, I'm talking too fast, with the exception that when you have the Power 3, or excuse me, when you have the 3 days down, oftentimes the blue is under the orange, and sometimes the white is under the orange. Makes no difference, they still react with a gap as long as you have the other 2 conditions, the identical pattern conditions and the down touch conditions. Now, then there's a variety of each. When we look at the market force recognition identical indicators, we have, let me briefly comment and say that we have each of those indicators as a radar screen indicator. And by that I mean you can go to the radar screen, you can set up the 22 market force recognition indicators, and if a 2-day a bottlenose comes up, or if a right leg W comes up, it has a box color code that identifies every right leg W higher pattern or lower pattern. And the right leg W is a pink box, and then if it's a right leg W lower, it's a light pink box with dark red text. Now, and again, those are all in your color, underneath the document that we call colors, and then box colors is in parentheses, and then you have the trend down touches, the Power 4 or proximity group box color codes, as well as the 22 market force recognition indicator box color codes. So just as long as I'm on this particular topic, and that I mean by that I mean the radar screen, you can, for example, you go to the down touch indicator for the 3 patterns in radar screen, and the 5 down touches, that would be, for example, trend red down touches the 3 trio lines the blue, pink, yellow, or the zero line, or it spikes down underneath the zero line on the first day. When it goes 2 days down, we usually don't mess with it too much unless there's a lot of supporting evidence. Now, those down touches show up if you're in the trend red down touch column and you get a blue box color, the trend red has down touched the blue line. And then you get a yellow alert for the yellow line and a pink alert for the pink line. The zero is what the color that I use. We call it a tan color. And that's what I normally use for all my zero lines in the charts. And then the last one is the down touch under zero. Now, all of those color box codes are, after you use it a while, you know what color is what color. But let's say you're on the down touch thing and you found a double. The red has down touched the pink and the green has down touched the blue. And so both of those color codes will show up in the red column and the green column. And then of course there's the gray column. And so by seeing two down touches, you got a double down touch. Trend red down touched one trio line and trend green down touched another trio line. Then you can take that symbol and go over to the radar screen, type in that symbol, and immediately see how many identical indicators there are and what it is. And sometimes you have two that work together, like the blue and the gray. The blue is a bottlenose and the gray is a 3-day up or down pattern. And oftentimes when we get a bottlenose, we get a 3-day up or a 3-day down in the respective bottlenose that appears. We usually don't count 3-day up patterns unless we have some bottlenose patterns to go along with it, because you can just end up spotting a bunch of uptrend movements. So, and not a reversal pattern like we're trying to find. And again, the entire day trading Visual Basics system is built on finding that cycle turnaround, finding that reversal pattern, finding that change in the uptrend, and now it's going into a downtrend. That's what and we did that because there are oftentimes really strong change movements, trend change movements. Obviously, gaps up or down are an example of that. But it's nice to be able to grab the bottom of the cycle and pinpoint that last red candle and buy it in the morning, and then ride it in a 3 to 5 day uptrend or whatever happens. And so if you go to the proximity group indicator on the radar screen, you then are shown the 4 columns of the 4 colors. There's more to it than that, but just when you go there, you can see the 4 columns, and each one of those has a box color alert for the respective pattern that it might be in. One of those 7 patterns that I talked about. There are, like, for example, you can have a crossover pattern. The power 4, the pink, blue, white, and yellow cross over the power orange line. Then they could cross over the power orange, the power green, and the zero line at the same time. When that happens, and you have supporting conditions to go along with it in the downtrend chart and the identical indicator chart or indicator situation, one pattern situation, when you have all 3 conditions with a crossover, it works as a gap up. but we don't have the crossover. Excuse me, we don't have the crossover listed as a pattern, one of those 7 patterns that are as a viable option in the 7 or 8 drawings that we have for those different shapes that are necessary for the power 4 to be in that cause a gap up. Now, all that being said, you begin to understand that you have to have the 3 patterns. The 1 pattern, the down touch pattern in the trend chart, and the proximity group patterns, one of the 7 proximity group patterns. There is or can be supporting evidence to even all of this stuff, okay? You could have additional down touches in a different chart, like the zip chart or the power chart. But the primary chart that we always look at is the trend chart, and that's the most powerful. Somewhere in the vicinity of 75 to 85% of all down touches that occur do so in the trend chart. And so it's that recognition, it's that identification, it's that signal that tells us of a reversal that's going to take place. The pink line, the yellow, pink, blue line, the trio, the pink line is the most powerful line to be down touched. And that is the center of that trio configuration that we see. And again, the trio moves the trio is one group out of the 3 groups that are the 7 short-term trend lines. And the trend trio moves faster than the power orange or green or the swing red and green. The swing red and green never cross each other. That's not true with the other, with the other lines. One additional idea that I want to convey is supporting evidence, and we can pick that up in the 1 pattern or 2 pattern configuration that we see. We define the 1 pattern as a majority of identical indicators. In other words, we have 22 market force recognition indicators, and those 22 serve as the sensitive indicators that are able to share with us very quickly the pressures and the forces within the market and pick up on the pending price change that's going to take place. And a lot of these, especially the zip chart, it has what we refer to as leading indicators. In other words, they tell you about leading indicators. The leading indicators tell you about what's going to happen. That's the basic definition, or generically what we think about when we think of a leading indicator. Swing pink and swing red are the 2 fastest lines in the entire system. Those 2 are obviously leading indicators. Your swing pink, swing Zion, and your 3 price lines, the red, green, blue, all 5 of those are price barometers, and they move with the price. You've heard me talk about the zip green and zip Zion. Both of those track the buyers going in and out of the market. And I say it that way, but really it's tracking the number of trades that are being made. You can have a small group of people making a lot of trades in one direction. When zip green is at 100, there are a lot of people going into the trade. When zip green is at 0, there are a lot of people leaving the trade. And zip Zion is the grandfather to zip green. It takes a lot more power to move Zion to the extremes. When zip Zion is at 100, you obviously have many more people entering the marketplace, entering the stock, Excuse me. Likewise, Zip Green or Zip Zion at 0, you have a lot of people heading out of that stock. Now, if you have, let's say you have 9 identical indicators in one pattern, and then you have 4 or 5 identical patterns in another type of pattern. This is referred to as a 2 pattern. When the 2 together will end up being fairly strong. By that I mean more than a majority. In other words, you have more than 12 indicators in the 2 patterns. Now, just to clarify this, I've seen, I think there were 5 patterns I saw, and each of those patterns had 2 or 3 specific identical patterns, all of them different, but the total together got over 12, and that was a nice gap up. So you need to identify with what makes a gap up there, and one of the best ways to do that is through an Excel program where you just mark down a day when you find a gap, and then you start identifying and marking down column information, and then after you do, I mean, you only need to do 25 of them, and you start to see significant similarities. And it's those similarities that repeat themselves. And so it's just a powerful system, but it's technical analysis at its best because of the sensitive indicators that we have to identify those tiny market force movements or those tiny market pressures that exist prior to the major price directional movement. If you have, in that previous example, I talked about having 9 indicators in one and 4 or 5 in the other. So now we're up to 13 or 14 indicators in those 2 identical patterns. Supporting, we got 22 that are there. And if we've got more box colors that are lighting up, we have supporting evidence. So we might have 4 or 5 more lines, the 22 market force recognition lines, that show us a pattern, one of the patterns going up, one of these shape patterns that identify a next day up. Keep in mind, there's divergence in these things. There's BOC patterns that the right leg can be higher or lower, and there's locations that are in divergence. For example, at the bottom of a cycle, you find a top of cycle pattern that's up and down, with the right leg of that pattern being longer than the left leg. That is a strong indication of a really strong force pushing it down, and when it's supported with 9 and 5 other identical indicators, or even when it's one of those 5 or 9, that's a stronger reversal reaction because the top of the cycle shape appeared at a bottom of a cycle position. So there's many different types of divergence. You can get a high M pattern, for example. In the price chart, I think of typically, you have a high M higher right peak, and it starts out where the right peak has the price green highest and the left peak has price red highest, and both of those lines are higher. In other words, both of those right peaks are above the left peak. Price green normally is the highest line that appears before the downtrend starts. That's one major short example that we find in the price chart when that happens. It's divergence between the two price lines. Another type of divergence is when the red high M right peak pattern is lower and the green right peak higher our right peak pattern is higher. So in other words, red is high on one and green is high on another, or vice versa. But typically the strongest gap down reactions that we get in the high M in the price green patterns is with the divergence between the right peak and the left peak, like that initial one that I talked about. But there's many additional videos on that and explanations as to why they work. But the key thing that I was trying to convey there is that if you've only got 13 or 14 lines, then you have 8 lines or whatever number you want to talk about. You have all the rest of those lines up to the 22 to also support this movement. And when you could find 8 and 3 lines, and you could have 5 or 6 in different pattern configurations that support the gap up movement. Totally then, you're in that 17, 18, 19, or 20. I've seen 21 many times. 21 identical indicators. You don't always have the supporting evidence to go along with that. And by that I mean you got to have the down touches. Somewhere in there, trend red, green, or gray needs to down touch one of those 5 lines. And gray is not one that typically, we think of it as a, or let me rephrase that. Trend gray typically rides near zero as it moves through the movements, the cycles. When you do see it, like previously when I mentioned all 3 of them spike down under zero, that is when you find gray down under blue and blue is right next to, and blue is at the bottom of the trio. In other words, the trio is under zero. When the trio is under zero and the red, green, gray are under the blue line, which is at the bottom of the trio, when it is under zero, it's at the top of the 3 when it is above the 0. The yellow trend line always stays closest to the 0 line. When you have that situation where you have that triple spike down, it's usually a fairly strong movement going up the next day. And we normally sometimes the gray will be under for a day or two, and then all 3 will spike down strong. We like to see strong spike down movements. And by that I mean your zip red can spike down 50 points or 70 points in one day. That's real nice to see. Trend red is also a strong down mover. When you have those really strong down movements, you typically, and you have, like I'm talking about with the 3 lines, the red, green, gray underneath the trio, which is under 0. So all 6 lines are under 0. When you have that, then the reversal is oftentimes stronger. 1-2 days, sometimes more. But all that being said, I was trying to emphasize that you love to see supporting evidence when you have or when you can have it. And by that I mean if you've got 19 indicators in an identical pattern, you only have 3 indicators that could possibly give you additional support. But if you got 13 or 14 identical indicators, then you got a lot of indicators that could give you additional support. And there's not an exact correlation between the, you got to have 21 or 20 or between the most indicators. It's a combination of things. Right leg W patterns are stronger than some other patterns. When trend red down touches trend pink, it's the strongest of the down touch reactions. If if you have a double down touch or a triple down touch, or if you have 2 down touches on the same line, those are just multiplication factors. We don't know where the gap up's going to occur, but the increase in the gap is affected by that supporting evidence. And so you could have 8 in one and 3 in another on the 2 pattern example, and then have a real nice supporting evidence in the down touch chart, as well as the proximity group. Or power 4 group, however you want to think of that. And all of those box colors alerts for those 3 different pattern groups are on the radar screen. It is so convenient. I mean, this is one of the reasons we built this system. We wanted to make it simple. We wanted to make it easy for you to spot information about market forces and market pressures, because the whole system is built on the indicator power, the formula power, and the procedures power. Possibly from previous videos that I ended up building close to 1,400 indicators, and we only ended up using 22 market force indicators. And there's 40 total. I mean, 9 of them, you got 4 upper and lower band lines, and the long-term trend line on the candle chart. So there's 9 right there. But the 22 MFR are the most powerful and give us the most information. And then you take the patterns, the conditions, and the signals, which is the formula. You identify one of those top patterns up or those top patterns down, and you verify it with bad, poor, or good conditions for each one. And you then use good conditions only, and when you do use good conditions only, you end up in a high probability trade, and we only trade high probability stocks. This is a pattern with good conditions. We only want high probability. Every one we do is high probability. And then you've got the procedures, and the procedures power is this. If you got, I used the example before, but if you've got 10, you've got 10 patterns. 2 of them are, as an example, 2 of them are going to end up with a nice green candle at the end of the day. 5 or 6 will end up with a little green candle, and a couple might even go red candle. What makes that difference? The difference is in the conditions within. And so we know what those conditions should be, and we identify those conditions that are good. We select those to trade. That's why the high probability is just way out of, how do I say this? It's way beyond normal. I mean, when you talk about high probability, normal might be 80 to 85% or more. But when we have 95% or 98% of this happening in that direction, we are amazed. But it's the formula. And when you analyze those 10, you're in the procedures process. You're analyzing how that, what those indicators are telling you about the price expectations. And that daily analysis is the procedures power of the system. And it's just like your analysis of the 3 pattern groups. You do that continually each day, and you gain knowledge and experience that it changes your trading. It gives you a power to recognize what's going to happen like no other system I've seen. So that video was designed for how to find gaps. I hope that was an effective video for you. It's there's convenience here in this system. The system is simple. We made it that way because I was a beginner in 2007, and I didn't know what I was doing. And I wanted a system that I could analyze the market and see what was moving and why it was moving and how it was moving. And I spent years creating very sensitive indicators. And I thought I had a system, but I didn't have a system until the day that I began to spend time on the patterns that I was identifying and seeing that would gap up or move up strongly, until I started putting those patterns together. Because there's over 20 patterns up and 20 patterns down. And when I started putting those together, then the patterns with conditions fell into place. The formula fell into place. The analysis on how we were doing it was just the next step. And we realized that we had 3 powers within this system that meshed together, created something that gave us extremely high probability trades every time we made a trade. So we're excited about it. It's something that is amazing. We think you will be too if you look carefully at this system, because if it won't revolutionize your trading, it will tremendously increase your ability to identify great search methods or techniques to pick the right stock. And when you have the signals that'll tell you when to get in or to get out, it increases your profit margins. So have fun trading. We're excited.